All right, in this video, we are going to provide awareness on different life insurance companies and their PUA limitations. In our last video, we touched on how to design a policy for maximum cash value and really where your money is going. So you can decide where your money goes between the premium or PUA rider and how really to juice that cash value up. So where we left off was with the 5 companies we are going to go through. So in this video, we're going to provide information as far as what specific rules on what these companies allow and do not allow with their paid up additions rider, which of course is the key to maximizing the cash value with your life insurance policy. So let's get on into it. To begin, we will start at the top of our list, which is MassMutual. So MassMutual, a behemoth of a life insurance company when we look at them. MassMutual is one of your 4 major mutual companies. One of my personal favorites. We use them and Guardian quite a bit at our practice, but we can show any option with the exception of Northwestern Mutual. But MassMutual, how they work with respect to their PUA limitations, beginning with the maximum blend, 1090 split. They will not allow any agent to issue a policy that is more aggressive than a 1090 split. That is their maximum. So what that means, to provide some specific details here, is if you said, I want the ability, not commitment, but ability to pay $100,000 per year, and I like MassMutual as a company, that is my preference, how it would work is like this. We could set it up with a 10% minimum premium. That would be $10,000. We would need to attach a term rider as well. But the other 90% can be directed toward PUAs, 90 grand. Now, when I say we will need to attach a term rider as well, what that would actually look like, it would depend on our age and health rating, but we might have, call it $89,000 directed toward the PUA rider and another $1,000 going toward term. So my point is, the lowest we can drive the base premium is 10% of the total desired payment. So MassMutual's, their illustration software, they actually made a modification recently, which I love, that they will not allow illustrations to be shown with designs that are more aggressive than 10xing the minimum base premium with respect to your total payment. So if 100K was your max, the lowest you could set that premium is $10,000. If $10,000 was your max, we just want to take a 0 off here, $1,000 would be 10% of $10,000. So whatever the total payment is, 10% is the lowest MassMutual will allow, with the exception of catch-up payments. So if you're making catch-up payments, meaning you're making up for lost time with unused mech space, we have for years done that with clients, has not been a problem at all. They do permit that, provided you have their LISR rider, which is their 1-year term rider. That's how you avoid underwriting. The one other exception to a 10% minimum base premium is very rare, but I do want to hit on it. It's not very rare, but it has to do with a 1035 exchange. Then the limit is 20x and only in the first year. So a 1035 exchange is a tax-free transfer of cash value from one policy to another. How MassMutual views this is the base premium can be no less than 5% of the total first year input. So what that means is, let's assume you are paying in $100,000. You are also 1035 exchanging, transferring cash value from an existing whole life policy. Let's assume that that figure, the 1035 exchange, is another $100,000. So in the first year, the total dollar amount that MassMutual will receive from you, meaning 100K out of pocket and another 100K from the 1035 exchange, will be $200,000. Whatever that total dollar input is, it cannot exceed greater than 20 times the base premium. So if the total dollar amount here, we add those two together, is $200,000, you can divide it by 5. Call it 5%, which would be $10,000. And then from that point forward, 100K per year, you would have a 1090 split. If your 1035 exchange, let's take the same scenario here, but let's say it was a larger 1035 exchange which we don't do a whole lot of 1035 exchanges. They do have to make sense just from a pure guaranteed and non-guaranteed standpoint. But let's say it was $200,000. So you're paying in still the same 100K plus a 1035 exchange of 200,000, which means the total first year input would be $300,000. If you were to take 5% of that, it's not $10,000. So now it's $15,000. That would be the minimum base premium for the first year. Well, every year your base premium doesn't change unless we reduce it. But from year 2 onward, you'd be paying in $100K per year and you would still have a $15,000 base premium. So it would look like a 1585 design. However, you do have that large first year input, which a lot of times a 1035 exchange can make the numbers look very, very good. But again, we do have to factor in the existing whole life policy. 1035 exchanges do not always make sense because you're taking on a new policy with new expenses, all that good stuff. But with MassMutual, 1090 split, whatever your total payment is, minimum base premium, 10%. As far as their PUA flexibility, to provide some additional information here, again, if you have their 1-year term rider attached, which is referred to as their life insurance supplement rider, if that is attached, you can make payment adjustments every year on your anniversary date without any medical underwriting at all. If that is not attached, you are subject to MassMutual's AILR rules, whether that's their scheduled AILR, unscheduled AILR, or planned AILR, which can be a bit complex. I would check out our All About MassMutual video as we go through all of the AILR riders that are available with MassMutual. So if we've got lister attached, makes life easy. We can adjust payments up and down without any medical underwriting. Random PUAs may or may not require medical underwriting based on MassMutual's AILR rules again. So 1090 split is as aggressive as we can go with the exception of a 1035 exchange. Guardian, good old Guardian, another one of my favorites, one of the 4 major mutual companies. So the most aggressive we can go with Guardian. So there's some additional rules here we've got to be aware of just for full transparency. We can 10x the base premium as long as a 1-year term rider is attached. If a 1-year term rider is not attached, then the highest PUA payment we can make on an annual basis would only be 3x the base premium, not 10x. And one thing I mentioned here, it's 10x the base premium, not a true 1090 split. You can actually go a little bit more aggressive here. Doesn't really matter, but to be precise, whatever that base premium is, let's assume it's $10,000. Guardian will allow, this is if a 1-year term rider is attached, another $100,000 per year to be paid into that paid up additions rider. That can be through a scheduled PUA payment, can also be through an unscheduled PUA payment. Guardian does offer a lot of flexibility where PUA payments can be added at leisure. This can be through your online portal, can be through a mobile app, can mail in a check. They do provide a lot of flexibility in that respect. A lot of people are attracted to them for that reason. Now, if we're max funding a policy, what'll happen eventually is that 1-year term rider will expire and you'll have a pure whole life policy. So when you no longer have that 1-year term rider because it expired or because you chopped it off, the maximum that you can pay into PUAs will be 3x the base premium. So for example, if you have that same $10,000 base premium, and this is without a 1-year term rider, now the most you can pay in is $30K per year. And that can even drop to 1x depending on whether or not the PUAs are scheduled or unscheduled, how many years you're into the policy. There are some limits, but the main thing is if we design a policy appropriately or correctly with Guardian, you can easily 10x the base premium. And one more thing I want to add here, which is beautiful, one of my favorite things, which has to do with the first year excess. So Guardian, this was actually a result of the 7702 change when guaranteed rates were reduced in the industry. They revamped their product portfolio, as all companies did. And the first year, they'll actually allow more than 10x the base premium. they'll allow a maximum of up to 50 times the base premium to be added in a PUA payment. So we can really exceed that 1090 split limitation, and we can easily do that without a MEC as well when you design the policy properly. We'll look at that in some of the future videos or the upcoming videos to follow this one. But you can really do a lot of damage in some situations. Sometimes it doesn't make sense. It depends on our age, health rating. We've got some videos which go through an analysis on that. But you can exceed 10x the base premium in the first year, no problem. They allow that, and that's with a MEC policy and with a non-MEC policy as well. But Guardian, typically, as long as that 1-year term rider is attached, you can pay 10x the base premium in PUAs on an annual basis, or at leisure on an annual basis, but you can add them whenever you want. New York Life. So the best way I could explain this is like this. New York Life, you can add PUAs at leisure like Guardian. You can pick up the phone, send funds in. They have a lot of flexibility if the policy is underwritten correctly up front. Here's the big thing. They refer to their PUA rider as their op rider. As time passes, the policy will become less and less flexible. And the reason why is because as we age over time, all insurance companies are concerned about this, as we age, what are the chances of us becoming more healthy compared to becoming less healthy? Most people have health issues as they age. So what New York Life does here is say, okay, we'll start out, year 1, you can pay 10x the base premium in PUAs, no problem. But as time passes, you can still add at leisure, but the multiple of whatever the base premium is will gradually reduce. So for example, if you have, let's use that same $10,000 base premium, the same would be true if it's $1,000. Year 1, you could throw in $100,000. Let's say it's year 3, you could throw in a maximum of $60,000. Now you can exceed these limits, you can pay in more, it's subject to approval. You've seen people do this. The only thing that's required, which is a pain for some people, is underwriting to do so if you want to exceed the standard PUA limitations. But they do offer flexibility, quality company. We've seen them deliver when we've examined historical policies, but they do have some limitations with that PUA flexibility, but the max, at least initially, is 10x. And if you wanted to 10x each year, it would just be subject to medical underwriting, and we want to MEC test the policy or design it appropriately up front so we don't run into a taxable event. Let's continue on here and look at some smaller companies. Lafayette Life, a smaller company that we've had some more questions around lately, so let's dig into them. So Lafayette, small company, but very flexible, and they do not have a multiplier like MassMutual, Guardian, or New York Life. When I say multiplier, what I mean is take MassMutual, that's the most straightforward in my opinion, 1090 split. I'm going to pay $100,000 in, the lowest I can set that base premium, 10%, which would be $10,000. Okay, sweet. Lafayette Life is different where they do not have that multiplier, so there's no percentage as far as a minimum is concerned. What they will allow is a maximum annual PUA payment of $500,000. So $500K per year, anything higher than that is subject to medical underwriting. That's specifically in their contract language, their company memos, illustration software. That's the max there, unless you want to go through underwriting and they approve it. Now, here is what sets a limit. So the lowest, typically we can get that base premium for a young, healthy individual. It's right around 3.5%. You'll see that in some of the upcoming videos. 3.5% base premium. I just rounded down there, $397. So what that means, you probably know what it means, but I'm going to write it out anyway, is again, if you're paying $100,000 per year, 3% of that is what? $3,000. That would be your base premium. We would have a term rider attached as well. But then everything else we could just pour into PUAs, which will look very, very strong up front. If you like the idea of having an absolute minimum premium policy, you say, you know what, I'd like to start at the lowest entry point with really having the flexibility to add more funded discretion, could be a nice option in that respect. You know my stance if you've seen any of our content with the 4 major mutual companies, but here's a nice option for someone who wants a lot of window room to add more funds and a low base premium. Here's the catch though. So first, some information is why we can't go lower than that 3% because their limit is 500K, is there are limitations that have to do with their term insurance rider. So to be able to have a 3% base premium, if I want to throw in 97% above and beyond the base premium and I just have a pure whole life policy, that'll mech every single time. Typically, if you go any lower than 30%, in most cases, sometimes it's 40% on the base premium without a term rider, you'll trigger a mech. So if you want to go lower, you do need to add a term rider. Now, Lafayette Life, they do not offer a 1-year term rider. They have a level term rider available, which means it's a level death benefit at a level premium. Here's the thing. Whatever your whole life death benefit is, the term insurance rider cannot exceed 12x whatever the whole life death benefit is. An example, you have a whole life death benefit, which let's assume you backed into that figure. You wanted a $4,000 base premium. So the base premium has a direct relationship to the whole life death benefit. On an illustration, you'll see this referred to as the base face amount. Now, if that base premium, we wanted $4,000, and that got us $100K in whole life insurance, that means we can add a total of $1.2 million in term insurance. When you add the two together, your total death benefit has a direct relationship to the mech limit. So again, we mentioned this in our last video, knowing the rules of the game, right? The rules of the game with the mech limit, different insurance companies, PUA limitations. If I know the rules of the game, I can stay within the boundaries and win the game when it comes to a high cash value life insurance policy. But knowing the rules of the game, if I want the ability to pay in $100K per year, and I say, give me the minimum base premium possible, and I'm looking at the smaller company here, well, here's a quick example, a whiteboard demonstration. Minimum base premium, $4,000, gives me a whole life death benefit. Add the term rider, total death benefit gives me that 100K mech limit. So I can commit to 4K, call it 5K with the term rider, and pour in excess funds at discretion. PUAs may be added at leisure. So that is a nice feature of Lafayette, like Guardian. You can just throw them into the policy anytime you want. One very important thing to mention here. So with Lafayette Life, they do have what is referred to as a 7-year rule. So how this works, to be very, very specific, is with your PUA payment. So this applies to PUAs. Let's assume that you're paying in $100,000 per year into the PUA rider. So not your total payment, but PUA payment specifically here. That's the maximum. You're funding up to the mech limit, just a nice round number there, 100K per year. What Lafayette Life will look at is what is the total dollar amount, the total PUA payments you have made over the first 7 years of the policy. Specifically, they'll ask for your 7-year average. And whatever that 7-year average is, your new maximum PUA payment you can make each year without underwriting, beginning the 8th year, is that 7-year average. So for example, let's assume you were approved to pay in $100K per year into PUAs, and you did that for 7 straight years. Well, what that means, you paid in $700,000. Lafayette will divide that number by 7, beginning the 8th year. 700K divided by 7 years is 100K. So you can keep paying in 100K. Nice. Now, let's assume, let's put this in a different color here. You paid in a maximum, you approved for 100. Maybe you paid in 100 one year, then 20 the next year. Let's just say over 7 years, you paid in total PUA payments $350,000. What that means now, beginning the 8th year, the maximum PUA payment you can make each year without underwriting would be that number divided by 7, which comes out to what? $50,000 per year. Anything higher would be subject to medical underwriting. So it is important to be aware of what that 7-year average is, or just have awareness on it, because if I scale back on my payments for a period of time, and then I want to make a catch-up payment down the road, I am going to have some limitations based on their PUA limitations. They're just their contract language and what they accept and do not accept. So that's some info on Lafayette Life. We will look at some examples of them in the next couple of videos. And last one for this video, Penn Mutual. So Penn Mutual, they do allow 10x the base premium to be paid into PUAs. However, when you look at their actual design limitations, like what can I actually do with a policy that's designed for maximum cash value? Typically, depending on your age, how long you want to fund it, health rating, there's a couple factors. The maximum split you can usually get will range between 15% base and 25% base. So 15% meaning, again, that 100K example, 15K of it would be directed toward the base premium and the other 85 toward the term insurance rider and PUA payments. Now, some additional info on them. They've got 2 PUA riders available. You've got your enhanced paid up additions rider and the accelerated paid up additions rider. In my opinion, the enhanced PUA rider is great if you wanted to fund for a very long time period. You said, okay, I want to be able to fund this bad boy for the next 25 years or a long period of time. That's a great option. You'll see more cash value up front and strong long-term performance. The accelerated PUA rider functions more closely to MassMutual or Guardian's 1-year term rider, where you're buying down the term aggressively as you're funding money into PUAs. This is great if you're funding for a short period of time, call it 10 years or less. It could be longer than that. 15 years or less works too. I'm just going to use a round number, call it 10 years or less. That's where that accelerated PUA option is nice. Personally, if you are considering Penn, I like to look at both. Unless you say, just show me the option with the most cash value, non-guaranteed and guaranteed, then we can do that for you as well. But if you are exploring your options, you just want to understand the limits here, there's nothing wrong with seeing both. This is your money going into a policy, so it's good to see all options up front. And then the last thing to hit on here, they have what is referred to as their annual payment limit. So I said annual PUA, annual payment limit. Got a 5-year rule here we see. So whatever your maximum PUA payment is, you must be approved for that from an underwriting standpoint before starting a policy. Let's assume in this example, you're approved for a $100,000 annual PUA payment. What Penn Mutual will do is they will look at your total PUA payments, and you've got a 5-year window. It's a rolling 5 years. So what this means here, 5-year window, or I should provide the rest of the info first, is 50% of your annual payment must be paid over 5 years. So as an example, if you're approved for $100K in total annual PUA payments, over 5 years, Penn Mutual will want to see a total of $50,000, 50% of 1 year's maximum PUA payment paid in over 5 years, which would be an average of $10K per year over 5 years. So it's a low amount, but I do want that awareness. The reason why is if I miss that window, if I go more than 5 years without making a PUA payment, and then I want to, or not hitting 50% of my annual payment limit that is, then I want to start PUA payments again in the future, I may have to go through medical underwriting. They reserve that right. It's very possible. You cannot illustrate resuming PUA payments if you go beyond that limitation. And the reason why we can't illustrate it is because underwriting would be required. So a lot of info there. I hope that this video was helpful. We're going to go through some actual examples in the next several videos. We're going to look at primarily examples where we can exceed the 1090 split ratio. So we're not going to look at a 1035 exchange, not in this series at least. What we will look at is examples with Guardian, and then we've had requests for Lafayette Life lately. So we're going to look at some examples with Lafayette as well. Hope you enjoyed this video. If you have any questions, please hit the like button, subscribe for more. Feel free to leave any questions in the comments. I do check them on a regular basis and try to answer them whenever I can. But thank you so much for watching. We do appreciate it. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.